Well, here we go, the UK stocks I'm buying, May 2024 edition. This is where I talk about all the stocks that I bought from the 1st of April to the 1st of May and all the stocks that I sold from the 1st of April to the 1st of May. And I've done this series on the YouTube channel for many years now, so it just keeps up that transparency because anything that I've bought is on this video and everything I've sold will be on this video, and I've done it for many years so you guys can track along with how I'm doing, and I'm not hiding anything. I'm not buying something quietly in the background and then only showing you when it works out. I'm not buying something and then selling it out in the background that didn't work and hope you don't notice. I give transparency here, guys, so you know what's going on. There's no fudging going on at all. And apologies for it being quite a bit of a delayed video. Normally I get this done quite early on in May, but it's just been so busy with earnings season that I haven't really had the time to do it. But here we go. I was quite active. There's quite a few stocks I bought on the UK side, so I'm going to try keep it a little bit brief. Normally I do quite a big deep dive into some of these stocks. Today I'm not going to do that because it will just take too long because there's that many of them. I'm seeing a lot of attractive value on the UK markets, especially in the last month compared to the US. So I've been quite active on the UK side. And as well as that, there was quite a few sells last month. I was quite active on the selling side of it as well. Two of them were sells because I was seeing better opportunities. One of them was to do with a buyout, and the other one was I lost a bit of faith in the management team. So anyway, I've been talking for too long. Let's get started on today's video. And as always, if you want to see my live buy and sell alerts, join the Patreon. It's £5 a month. You join through the link in the description, and on there you'll see in real time what I'm buying, what I'm selling, and I'll also give you 2 exclusive videos a week. And a Discord with 500 members on to talk about stocks, including me and plenty of other good investors on that Discord. And it's all for £5 a month, guys, at the price of a pint. It's probably the reason why it's the highest subscriber to Patreon members out there on the whole stock market YouTube scene, guys. So I try to put a lot of time in there, and I'll try get some more videos to you guys on the Patreon as well this weekend. So if you could support the channel, there you go, guys, and there's plenty of rewards there for you as well. Anyway, number 1, Gaming Realms. I have been buying Gaming Realms through the month of April into May, and I'm not even going to lie, I'm going to tell you a little bit of a secret. I have even bought this week, so I've been buying. But the funny thing is, actually, when I started buying this stock, it actually started having a dip, as you can see here. So I was actually down on the position, and then all of a sudden I've actually gone break even, and I was averaging down, and now I'm actually up on the position. So I'm actually averaging up on the position a little bit recently as well. But it's had a fantastic time. I've only been in this stock for, like I say, around about a month, maybe a month and a half. So a really, really new position to the portfolio. When I started buying, it was actually down at 16 times earnings, which I thought was really good. The fact that it was discounted to the market was very good. And even now, I don't actually think it's too bad at 20 times earnings, and that's why I'm okay just averaging up a little bit on Gaming Realms. I did a full video on the YouTube channel about 2 weeks ago talking about this one in a little bit more detail if you do want it. But basically, Gaming Realms, they are a provider of online games, and a lot of it comes through this site, as you can see here, Slingo. This is one of their main brands they do have, and they operate Slingo through different variations and also other ones like Deal or No Deal, Space Invaders, and they partner with a lot of the big companies that you would want to see, BetMGM, DraftKings, Entain, Flutter, and they use this brand as well to obviously take commission from them sites using these games. And with the growth in online gambling through Asia, through the US as well, which we've covered many times on this YouTube channel, it has very much big drivers for them to do very well. And if you were to go on Slingo here, that has its own dedicated section on Paddy Power, it's obviously a pretty popular brand if they're having their own dedicated section on the Paddy Power site. And the recently came out financials that were absolutely amazing. Revenue was up by 26%. If you look at adjusted EBITDA, that was up by 29%. And the balance sheet is just getting stronger and stronger. And the thing is that on this report, the stock went down. The stock went down on this report. So before we've had this recent rally, the stock actually dropped like 10% on this report. And it was like, no, you don't drop on a report like this. This is a very good report, and it should have been up over 10%, not dropped 10%. And that was the trigger for me to get in. I've been watching this stock for probably 3 months. It was brought forward on the stock request on Discord. I think it was Lemon who brought it forward. Did the review on it, and I was like, wow, this is really good. And I've just been watching it for the last couple of months, and it just started on that downtrend. I went, that's it. That's the time to go. And with the update as well, I was like, this is the time to start the position on this one. Like I said, the fact that it's 20 times earnings, and this is a company that's growing in very good rates. The profitability is growing at very good rates, and it has many future drivers to go, and the profit margins are very good. I mean, just look at the growth in the last few years and the growth that it will have in the next few years. It looks very attractive. Financial health wise, cracking balance sheet. That was the big tick for me as well, is that there's no debt on there. The cash they're throwing off means they're going to have so many options what to do with that cash, whether that be through acquisitions, dividends, buybacks. It's going to have a lot of choices in the next few years as it throws off this profitability. So Gaming Realms is definitely one that I really like at the moment. Next one's Money Supermarket. I actually just got my dividend today from Money Supermarket as well, which was really nice to receive. I forgot how good that dividend is. 5% dividend yield is really nice when you actually start receiving that. And yeah, I mean, I've been building the position up for a while in this one. The only annoying thing is I started building the position, it started rallying up, so I was averaging up a lot. And then the last kind of couple of weeks, it's actually started falling down, which was annoying. However, for you guys, I guess that gave you an opportunity to get in. But the last kind of week, it has rallied up a little bit more since I started buying. So I think I'm about happy now with a Money Supermarket position, unless it goes down into like the £2 range. But I'm sure you're aware, Money Supermarket is a comparison site, so they offer a lot of comparisons between car insurance, home insurance, broadband, travel. And normally what happens is one part of this company goes skyrocketing and it covers for all the other parts, and then when that has the cooling off phase, another part skyrockets. So for example, travel was like a major boom through like 2021, 2022 as everyone went on holiday. Now everyone's getting a bit tighter on money. Insurance premiums are going up with inflation, and people are getting like, oh, okay, we need to massively compare our home insurances now. And that's now the next big driver that's currently going on with it. One of the big things that will also come in the next 2-3 years is the energy price cap. Obviously, we've seen that really hurt the comparison site for a lot of energy companies, and this basically hasn't existed in Money Supermarket's business since like 2021, and that still has to come back. So that's going to be the next driver for this business whenever that does come back. And if you look at the financials, for example, you can see the big drop off it had during COVID, and that was obviously to do with people not traveling as much and a few other impacts like that. So you can see the company as a whole, it had that decline in revenue and profitability. And by the time we had the energy situation going on as well. But since then, obviously the financials are now basically nearly higher than where they were before the whole COVID situation. And that's with them losing the energy part of the business, which was a major part of the business. So if that starts coming back in the next couple of years, I really see the path where we see good growth with Money Supermarket, the profitability. I see the path to over 100 million in profitability, which would be probably towards more 12 times earnings, which would be very attractive for a business that pays a 5% dividend yield and would have the option to hike up that dividend even more. Pretty decent balance sheet, 15% debt to equity. Obviously throw off a lot of cash, so that balance will rise quite a bit. There's been a lot of insider buying, unfortunately that it's just gone past the last 12-month phase, but there was a lot of insiders buying up on this kind of level as well, which was really good. So yeah, I'm a big fan of Money Supermarket. Next one was Barrett Development. So Barrett Development, obviously house builder in the UK, houses in the UK, massive shortage. Obviously you want to own something where there's more demand than supply, and that's what's going on in the UK. We are short by about 4 million homes. I think overall we should be building 300,000. I think that's the government target, and we're over 50,000 short every year on the housing side of it. So we need more houses. The government will support this because we need more houses, and as well as that, obviously a lot of these stocks are being hit by the interest rate environment at the moment. This is probably the worst it's going to get, and I think we have seen the bottom in the UK housing market at the moment. So we actually had the shares pretty much drop out in the last kind of yearish. Since then, the house builder stocks have rallied up a little bit more, as you can see here. But what happened during the start of this year is that we actually had a fair bit of a drop in Barrett Developments. Some of it might be around the acquisition of Redrow and a bit of nervous, with it being such a big acquisition, maybe a little bit of nerves kicking in around that big acquisition. But I thought, you know what, this is a good drop. We're getting towards the prices that we were at back in 2023. I'm going to add some shares here. And like I said, for me, I think we're kind of towards out the end of the worst of this UK housing market right now. Housing prices are starting to rise again. Everyone knows priced in these higher interest rates now. And what's going to happen probably in the next couple of months? The Bank of England are going to cut interest rates, in my opinion. There's been hints about it, and I think it's going to come. I said that I believe we'll have it in summer. I believe we'll actually finally do something different to the US. We seem to just follow the US around, but I actually think that we might make the first jump here and cut interest rates. And as soon as we start getting those cuts in those interest rates, guys, that UK housing market will come back rapid. And I think we've passed the bottom in the UK housing market right now, and I think someone like Barrett Developments will set to benefit massively in the next few years as that kind of comes back. Obviously, financial wise, they have been hurt, but the growth will start coming back, the revenue will start coming back. Balance sheet wise as well, it's not a bad balance sheet at all. I mean, it sits around 3% debt to equity, which isn't bad. There's been a few insiders buying as well. Same again, it's just kind of run out over the last kind of 12 months. But yeah, I think you need to have a UK housing builder, and I think Barrett Developments for me is the best in the business on the UK side of it. The next one is Watches of Switzerland Group. So I did start buying some shares in Watches of Switzerland Group. For me, this is a turnaround play. So this is a company that's had some bad financials, but I feel like in the next coming few years, they will turn it around and I'll get the rewards on the share price. Just to show you the share price, you can see how much it has been hurt since 2021. It's down 76%. But like I said, I feel like we could be near the bottom now. The financials turn around and we start seeing the recovery in Watches of Switzerland. I'm sure most of you have seen the brands before. Watches of Switzerland, they do sell Swiss watches with 16 stores in the United Kingdom, and they have a couple of other brands as well, like Goldsmiths, and they're also expanding into the EU and they're also expanding into the US as well. I'm sure you've seen all the branding before, selling Rolex, one of the main players. That's probably one of the things that has caused the stock to go down, is Rolex have bought recently a retailer who do sell watches, and I think few people are worried that they are going to prioritise them over Watches of Switzerland. However, I don't think they'll do that because I think it will hurt Rolex too much if they were to do that, but that's something also to consider. Now, what happened is basically watches, Rolex prices, they just went absolutely crazy. Everyone had loads of free capital in 2021, and the prices went absolutely crazy. Everybody was out spending all this money. Interest rates were really low, and now the combination of the economy slowing down, people willing to spend less money, the interest rates, that's caused the prices and people to go buy watches really slow down. And you can see the slowdown here in the sale prices that has gone on. Now, if you were to overlay that probably over the stock chart, I'm sure it looks pretty similar to the Watches of Switzerland stock chart. Now, my feeling is that when you look at this chart, for example, it looks like to me we are starting to kind of bottom out here, and maybe we are about to go on a bit of a recovery. I don't think we can go much lower than where we were in 2019, 2020 with everything that's kind of gone on. So I'm kind of thinking here the slowdown is starting to slow down, and we are going to start rebounding as interest rates go a lot lower as well. I think that obviously watches are a good investment. You know, if you look over the last few years, they will go back up in value. It's just when they go back up in value. And I think those combination of those factors starting to come in now, we'll see Watches of Switzerland start performing a lot better. So I am kind of on that plan here, and obviously the growth plan they do have, if they do get anywhere close to this growth plan, they're going to do very well. They plan to double the sales and profits by financial year 2028, and one of the big things they're going to do is by expanding into the US. Now, if you actually look on the recent earnings that they did, the US part of the business is actually still doing very well. It was up 8% in constant currency and 3% on reported rates, whereas the UK has been the weak, or the Europe as well, has been the weak part, down 7%. So if this is doing this well in this US environment, imagine when we have a better environment and more stores there. Hopefully the UK and Europe does start reporting, improving, and with the news that obviously the UK has avoided a recession, maybe that's near the bottom as well, and we start moving out of here. So I'm trying to find roughly if it's going to be near the bottom here, and I feel like this is probably a good time for it to do that. They have also made a recent acquisition actually yesterday, and they do throw off a lot of profitability still. I think 86 million in profitability is still pretty good for an 800 million pound company. Insider front, there has been quite a few insiders picking up some shares as well, and the only thing I will say on the balance sheet is that it was a pretty decent balance sheet. That debt will rise because of the recent acquisition they did yesterday, so the debt to equity is probably going to be more towards a 30-40% debt to equity, but obviously with the profitability they throw off, I think that will be manageable, so I'm okay with that. And the next one is JD Sports. Obviously JD Sports had to be on the list. I did add in some JD Sports. They made a good acquisition, which I'll talk about, and that's why I did buy it. But JD Sports is a stock that's been punished massively, down 25% in the last year. Year to date, it's down 24%, and I just don't know why. It's lower than where it was before the whole coronavirus situation, and it's crazy. This is an absolute bargain for me at the moment, and I've really thought about making it even a larger position. JD Sports, obviously, they sell a lot of brands. You've probably seen the stores on the high street, and they're always really popular. Basically, you know, they don't really have a lot of their own brands, but brands have to be in here because they're so popular. This is where everybody wants to go. So the likes of Nike and Adidas have to get the brands in here and give them like exclusive products, because the footfall they have is absolutely amazing. And they've absolutely conquered the UK, and now the US expansion is on. And they have been expanding rapidly into the US market. And what they did is they bought Hibbett as well in the last couple of weeks, which I thought was a really good move. I thought they got a really good valuation for Hibbett, and that's going to also expand the US growth plans as well. That's what I ended up buying some more shares for, is that I thought this acquisition was a really good acquisition. And just to show you on a financial point of view, you know, we talked about the share price being lower than where it was before the whole coronavirus situation. Before that, the company was doing 6.1 billion in revenue. They're now doing 10.4. On a profitability point of view, they were doing 246 million, and they're now doing 197 million. However, there was a one-time charge in there. So if you actually take the one-time charge out of that, they're actually going to do, if we look in a couple of weeks' time, they're actually going to do 604 million in profitability, which is very impressive. Balance sheet-wise, obviously when you're throwing off that amount of profitability, you've got a pretty good balance sheet, as you can see here. Insider front, there was a lot of insiders buying going on recently as well. They're also improving the dividend, and as well as that, the valuation is cheap. If you look here, people are using trailing metrics because of that one-time charge and go, well, it's 31 times earnings, that's quite expensive. If you actually look on a forward basis, JD Sports is actually currently trading at a forward P of 9, which is I think for a business like this is a very good value. And I also added in some legal in general. Was having a little bit of a dip recently, although it has kind of rallied out there, as you can see. But this is just an easy hold for me that I just get a nice 8% dividend yield. The financials are doing okay at the moment, and obviously as well, when they have improving UK economy, housing market starts improving as well. I think legal in general will continue to do very well going forward as well. And that leads me on to the selling. So like I said, I did sell 4 stocks. First one was Flutter. I sold Flutter out for, I think I made a video on it. I think I sold it for 30-something% return. So yeah, another nice profit for a stock that I've held for a little bit. I'm okay with that. I probably should have sold when it was a little bit higher. It was a little bit higher not too long ago, but I did sell out my shares on Flutter. And the reason why I sold Flutter is because I wanted to buy Gaming Realms. I didn't want to have exposure to Gaming Realms and Flutter in the portfolio. So if I was going to buy Gaming Realms, Flutter had to go because of the similar overlap of the industry, and I just thought Gaming Realms had the better valuation, the better balance sheet, the better growth. It just made sense for me to put in Gaming Realms. So yeah, I moved the money from Flutter into Gaming Realms, so that automatically put it to a pretty decent size in my portfolio, which I'm really happy about now. Dartrace, obviously I sold Dartrace. I made a video on this one as well. Obviously really good. You know, we made over 100% return once again on another stock, and yeah, I didn't really want it to go because I want a cybersecurity play in my portfolio, and I thought Dartrace was still a relatively good valuation. I think the company that have bought it out have actually got it for a very good price. But at the end of the day, we're here to make money, and if I make 100% on Dartrace after holding it for probably a year and a half, I'm pretty happy with that at the end of the day. So yeah, I had to sell Dartrace after the acquisition news. Team 17, I did sell Team 17. Unfortunately, it has rallied up a little bit since I did sell the stock, but I'm okay with that. I think we made a little bit of a profit, not much, I think like maybe 3 or 4%, so nothing to shout out about. And the reason why I sold Team 17 is I put that money into Watches of Switzerland Group that we talked about. I felt like I bought Team 17 as a turnaround play, but then when I started looking at the growth and how much of that growth would have to come from acquisitions, I looked and also the weakness in the gaming space that I'm seeing from a few companies in the recent conference calls. I thought, you know what, I'm going to put this in Watches of Switzerland because I think the valuation's a little bit better than Team 17's at the moment, and they're not having to rely on the acquisitions as much. I say that as Watches of Switzerland have just made an acquisition, but as much anyway. So I thought that was a good switch of a turnaround play. And the last one that I sold was AlphaWave. So I sold AlphaWave because the management team made me a little bit nervous. The big red flag I always had with AlphaWave was the management team. They had a bit of a history of smoke and mirrors, and their recent numbers they brought out, I was a bit worried. Like, they downgraded this 2024's year's guidance, last year's, this year's, and the year after that. And I was like, why are you doing such a big downgrade? And they blamed it on moving away from China. And I was like, well, surely you don't move away from China that quickly, that much, that it hurts your financials this much. and it just looks a bit dodgy to me. Like I just don't know why you would do it. You know, I understand moving away from China, but you won't do it this much to hurt your share price and your financials. It just looked a bit fishy to me. And I always said, like, the management team make me nervous, and if I ever see anything fishy, I'm out. And obviously that's what I said, and I followed through with it. And you know, I thought, you know what, let's move out of here, and we'll go put that money into something else, or another position, or add into another position. And you know, I might be wrong on this one. You know, when you look at the management team's history, they have a very good history at previous companies. But there's just a few things that are making Wall Street and investors a little bit nervous to buy them. And if they continue to do that, will they ever get the rewards on the share price? I don't know. So I feel like as well is that this should be the time. You know, when you see all, as a semiconductor company, when you look at a lot of semiconductors earnings at the moment, they're all on fire. So Alphawave, this is their time to really be on fire. And if they're not doing that at the moment, I'm like, come on guys, this is a time where you should be absolutely smashing it. So if you're not doing it now, you know, you make me a bit nervous for the future. So I did move my position out of Alphawave, which I think overall, I think we've made around, I think I sold that for 10% profit, I think it was. And then I think I sold for 20% profit the first time round. So I think I've made like 30% over owning it for like the last year and a half-ish, which is still okay. But obviously not what I wanted it for in the longer term anyway. But yeah, sometimes you just gotta, you know, if your gut's telling you that it's not right, I think sometimes you gotta go with your gut. If I did that with a couple of other stocks that went a little bit wrong a little bit earlier on, I would have saved myself a couple of big losses. So I'm doing my best to try and learn from that mistake. And if I'm seeing something that I don't like, you know, cut it. And that's what I've done. So yeah, those are the stocks I bought. Obviously quite active on the buying, and then the selling side, yeah, quite active on the selling side as well. But I think there's a good reasoning behind them all, why I had to move them on. So yeah, hope you enjoyed the video, guys. Have a good weekend. See you in a bit.